Today, we're joined by John Kicklighter, the global head of content at StoneX. With years of experience analyzing markets and helping traders navigate volatility, John brings a wealth of practical knowledge to our discussion. We'll be diving into how traders can better understand and integrate volatility into their trading strategies. John, thank you so much for joining us. So to start off, how would you define volatility and why should traders care about it?
There's different definitions of volatility. Volatility is generally the activity level of the market over a given set of time. Now, there's two types. There is realized or historical volatility we have seen, and then there is volatility that is yet to be seen going forward, so it's implied or expected. Volatility can just be rudimentarily thought of as how active a market is or has been. And when you see it in that bigger picture, you can have something as quiet and inactive as treasury yields, or you can have something as explosive as, let's say, a meme stock or a cryptocurrency that's less liquid. And the difference between those things means very different trading approaches and investing approaches, risk profiles that are probably inappropriate for certain types of traders or just not interesting for those that are actually looking for the volatility, because we can both seek and avoid volatility. So volatility overall is the activity level of a market.
So then what tools do you personally use to track or measure volatility?
So when it comes to historical volatility, where volatility has happened in the past, which a lot of people through technical analysis, they often like to look at what has been in terms of price action or activity level and project a expected range of activity or price over the given next period. I like to look at things like the average true range, which is a very popular technical indicator for something along those lines. And it measures, let's say, 10 candles, which is usually days, but it could be weeks, hours, it can vary. So over the past 10 days, how big has the range of this asset's price been? And then we can take that and see reasonably, let's say it moved 100 points in the past 10 days on average per day, then the next day can see an expectation of maybe 100 points on pace with the average. Of course, can go larger or smaller than that average range, but that's how you use a projection of a historical. There's also very popular indicators like the VIX volatility indicator. VIX volatility is one of the most popular measures on purpose. It's because it's derived off of one of the most popular indices in the world, which is the S&P 500. It's derived by options based on the S&P 500. Now, in that is implied volatility, which is derived from the standard options models. There's a lot of known components. And we historically have used options to hedge. Most people would want exposure to the underlying, usually going long the S&P 500 because there's a disproportionate interest in a buy and hold approach to equity markets. So that option, which was created principally to give a opportunity to hedge against that long exposure, so you didn't have to get in and out, and protect you against the unknown. We knew most of the terms of the options contract. We knew the strike price, we knew the underlying, we knew the interest rate, we knew all the other elements that were involved. One of the few things we did not know was the implied volatility, which is the unknown quantity. And we would pull out that unknown quantity, and the higher it is, or the more costly it is to hedge that position, it would insinuate that there's a greater risk, and that means there's going to be more volatility. That is probably one of the most recognizable. Now, I know we look at the VIX and we use it as a kind of general market indicator for volatility, and it does serve that fairly well, although I have some issues myself with it as an indicator. It's not what it was 20 years ago, but it is something we can take that implied volatility from not just a standard derivatives option model, or we can take it from other derivative measures, and we can take that expected volatility level from a actively traded market. So we can see how much risk is the market really pricing in, and they do so by deriving it from the hedging cost, or the cost of risk that people are willing to pay. And it's especially true when you have a lot to lose.
So, when volatility increases, how do you adapt your trading strategy and risk management?
So, depending on what your approach to the markets is, rising volatility can be approached in one of two ways generally. For the active trader, so the smaller retail trader, self-directed trader, and certain market participants where they're trying to get into a market that is somewhat inefficient. High risk, high volatility is inefficient.
Yeah.
And certain trade categories are looking for that inefficiency because it means that there's an opportunity to either arbitrage or take advantage of larger swings in price action if you have a strategy that needs that movement over a shorter period of time. So if you are of that type, you are seeking out higher volatility. Now, volatility can be different according to different markets. So if I were comparing something like the equity market to the sovereign debt market, equities would be significantly more volatile than sovereign debt. Or if I were looking at FX volatility versus emerging market asset volatility. Emerging markets are much more volatile than especially liquid FX, like a pair like the Euro USD. So if I saw a rising volatility relative to that market itself, so let's say I was sticking with one asset, the S&P 500. As the S&P 500's volatility rises, either the VIX is rising from 15 to 30, or if I see the average true range on the S&P 500 rise from 5% to 10%, then if I were a trader looking for that volatility, that would cue to me a need to go and look to employ a strategy to take advantage of that volatility, that price action. On the flip side, if I were, let's say, an investor or a hedger, or somebody that's actually looking to these assets as a means to sell a good, a commodity, for example, then I'm going to want to avoid that volatility. Now, while it does make sense for everybody to always have some kind of security to their exposure in any market, and that can be a stop loss already set because you have a clear threshold, or that can be a derivative or something along those lines. A lot of traders in particular and large investors will avoid having any of these until they actually think that they are necessary. Funny thing is, when volatility is really low and the markets are stretched, there's a tendency for no interest or a reduction in exposure to those hedges because they don't want to have those eat into the cost of their capital gains or their yield in otherwise quiet times. It's kind of a dichotomy, or it gets to the extreme. But if you see a rise in volatility, the need for a hedge, especially if you can't easily get in and out of a market, the underlying will rise. So as you see that volatility rise, if you're in this category, you want to seek out either a hedge, whatever that can represent, an offsetting position, a derivative, or you might want to just be a little bit more proactive. You might have a stop that, let's say, is 300 points away. You might want to move it 100 points away because volatility is non-directional. So if just volatility picks up, you might want to move that stop closer just to be safe.
So those are some good hypotheticals, but can you share a real world example where the trade and volatility has changed your approach or outcome?
Sure. I've been trading since I was about 16. So I got into trading because I was taught very early on how to do so, and the person that taught me was pretty much a jack of all trades in all markets. At the time, I was getting into S&P 500 options. So I was learning about standard options, American-style options, and getting into multi-leg exposures. So I was, at the time, I believe, selling straddles, meaning it's a position which I was looking at the S&P 500 to stay within a band of price action.
Okay.
And if it did not move outside of that band, that range, then I would just collect the premiums. That being said, I knew there was a rate decision coming up. This was a while ago, so I won't say which central bank chairman, but came out, had a tendency to be a little bit less, I think, projecting, a little less clear about intent as more recent central bankers, and decided to dramatically change the interest rate with no impression that he was going to do so. And that led to a massive move in the S&P 500, and then obviously it blew out of the range that I needed to stay in. This, let's say, had a very significant impact on my overall account. I had over leveraged, and I decided that it was more important to see event risk and put it in a category of possible volatility, not just assumed volatility, and looking for something that was convenient in terms of pricing and where I wanted price action to be. I also shied away from very tight ranges, especially around event risk, the strategies that would require that. And I started to use actually volatility more in the active application of my active trading. I look for volatility. I want volatility to either be rising, because usually I am looking for a move in the markets. Usually I'd be called a swing trader or a day trader, although it's usually longer than a day. So I don't look to avoid volatility, I look to take advantage of it. But if I don't have any kind of movement, which is kind of the opposite of what I used to look for in that kind of example, if I don't have any expectation of movement, then I can be sitting in a trade that never fulfills the objective for an indefinite amount of time. So I at least need volatility to start rising so that I can expect that movement in underlying price action. If it doesn't, then it would come from just happenstance or a miracle. And that's not how you operate a reasonable, repeatable strategy. So for people that want to adapt their strategies to whatever their interests are, if they're active traders, you can adapt your strategy to look for a rising volatility or a falling volatility or even a flat volatility. And if you're looking to hedge or avoid volatility, you can utilize that as a means to see how can I reduce my risk, and should I be looking for a greater effort or measure to actually actively reduce that risk through derivatives or whatever the offsetting consideration is. So a lot of ways to use volatility. It's one of my favorite elements of markets to incorporate.
Well, just to follow up on your example then, what would be some advice that you would give traders that are trying to navigate these volatile markets? If you could give one piece of advice, what would it be?
So I won't encourage you to go and look at the boring stuff of how derivatives are priced and how some of these work. I'm a little wonky. I do enjoy stuff like that, but I know it's not everyone's forte. They don't have the interest and the gumption to go and do it. But if you wanted to really utilize volatility, there's very simple means of doing it. It's as accessible as looking at something like the VIX, which is very applicable to many measures of the market, starting with the measure like that. If you have any exposure in a market that has an association to just general risk trends, risk appetite. So in other words, if the rise or fall, significant rise or fall in something like the S&P 500, the Dow Jones Industrial Average, has a meaningful impact on the market that you are interested in, then the VIX is also fairly good at giving you at least some heads up about volatility. And you can also, if you're take any look at charts, you can look at something like an average true range, often considered an ATR, and just see what is the general level of activity for this market. So if I see an average true range suggests that an average day for this market that I'm looking to get interested in is $3, and I am looking for an exposure and I expect it to last, let's say I want it to last a month, but I only put it $1 away, well, $1 fits a third of the day's range. I'm very likely to hit that, whether it's a good thing or bad thing, within a very short amount of time, not the longer term that I'm looking to do. So it can give you very practical expectations about how you should approach the markets, how much time it takes. I think a lot of people do not consider the time that their trade will be on, and they should. And volatility can absolutely help with that. And sometimes it just tells you maybe I should consider another market or sitting on the sidelines until the volatility passes.
Well, John, thank you so much for your insight. And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.